Hello everyone and welcome to the webinar. My name is James Hughes, Chief Market Analyst here at Scope Markets. Thanks for all taking your time out to join the seminar, to join the webinar today. And obviously the short notice of our advertising of this webinar means that the subject matter that we've got today is an incredibly important one, as we can tell by how markets have been moving over the last couple of weeks or so, how the news flow has been surrounding the coronavirus epidemic itself. Just shows you how important this is to financial markets and how much this story is going to dominate, not just in the near term, but how this story is going to dominate going forward. So let me give you a little bit of information about how we'll go through. We'll go for probably half an hour to 45 minutes, or maybe a little bit longer, depending on how we get on or how markets move or what we get through. We'll talk about exactly how coronavirus is affecting the markets, because of course that's the key point that we want to talk about here. It's not necessarily a webinar to talk about what coronavirus is. Of course, we've all seen the news, we've all watched the stories, we've all been online, we all have heard it 100 million times exactly what this is, what it's doing to people's health. But what we want to know as traders, we want to know is how this affects us in terms of our trading. What sort of impact this is having on the market, what sort of opportunities this gives us as traders going forward, and where are those opportunities? Are they on stocks? Are they on currencies? What currencies are they on? So we'll try and drill down into some of that information and give ourselves a little bit more of a heads up when it comes to exactly what we should be looking at. Also, what we'll look at going forward is how we can protect ourselves against this. Now, we have another webinar tomorrow talking about how we can protect our positions going forward, how we can protect ourselves from massive movements in stock markets, because the movements we've seen haven't necessarily been unprecedented, but they have, of course, taken everyone by shock. They've taken the markets by shock. We expect to see, we probably didn't expect to see such enormous movements in these markets. So tomorrow on our webinar, we'll talk about the risks. We'll touch on them today as well, but we'll talk about the risks, talk about how we can protect ourselves, and we'll look at exactly what to do if we do get caught the wrong side. But that's tomorrow. Today, we'll talk about how these markets are being affected, what's driving things, what various different countries are doing to stop this, because that's one of the big things, of course. Yes, number one, how the countries are looking to stop the medical side of this, but what are countries doing to stop the economic impact of what's happening here? And that the issue is that the economic impact of coronavirus could claim more lives than coronavirus itself. The economic impact has a massive effect on people's lives, and not just the money they have in their pocket. I mean people's lives globally. When people lose their jobs, when food shortages happen, when panic ensues like it has done on the back of this story, people's lives are affected. So yes, there is a human aspect to the medical side, but there's also a human aspect to the financial side to this, exactly how this affects the economy. So we'll try and touch on those things as well. But of course, to start off with, and one of the major things that we will look at, of course, is how we trade this. What do we look at? What are we supposed to do? What sort of analysis can we do to try and give ourselves a heads up? And one thing I will start by doing is by saying to you that because you didn't see this coming, because we didn't see the big falls in the Dow and then the subsequent turnaround in various different parts of the market, because we didn't see that coming, doesn't mean that we're not good traders, doesn't mean that we've made mistakes in our trading. What it means is that nobody saw this coming. And that's the point to the whole story, which is really why we've got this, why we're having this webinar at all, because the markets obviously give us no clue. And I said this to you before, so any of you that were at our seminar that we did at the Intercontinental Hotel in Nairobi would have heard me say this. Anyone who's joined subsequently to any of the webinars that I've done will have heard me say this again. So I apologize if this goes over old ground. But one thing we all have in common, and it's something we should all remember all of the time. There is one thing we all have in common, from presidents to central bankers, to the best traders, to the worst traders. The one thing we all have in common is nobody knows where the market's going. We don't have a clue. Now, we can make informed decisions. We can look at the markets. We can analyze, use our use our technical analysis. We can look at the fundamental news. With coronavirus, we can look at the death tolls. We can look at the countries. Is there a pattern as to where these are going? We can look at all of those things. But at the end of the day, we don't know what the markets will do. We don't know how big the swings will be. We just don't know. We don't know what's going to happen with that. So don't kick yourself for not knowing what happens in these markets. I didn't know what was happening in these markets. Nobody expected to see that happening. And the key thing is, going forward, over the next few days, we don't know how the market will react. We don't know what they will do. We don't know what the government will do to stop it. But we can have a look. We can try and analyze the charts, try and analyze the market, and see exactly what we can get from it. So we're on the MC4 platform here. This is the MC4. It's just a demo account. So it's a demo to show you exactly what's going on here. And I've got the Dow Jones. So we're looking at the Dow Jones, and you can see here, this is on a daily chart. This is the daily chart, and you can see the moves that we've had over the last few days. You can see the gap in here. We have had, I think it's now 6 days since the outbreak of coronavirus got serious, if you like, from a financial point of view. We've had 6 1,000-point down days on the Dow Jones. Okay, not consecutively, but we've had those. Now, what we have had and what we tend to get, which sometimes makes us worry, is the fact that markets rebound, and they rebound almost instantly when we see a massive fall like that. So yes, big falls to the downside, and every time we've seen 1,000-point plus move to the downside, we have been greeted initially with upside. And one of the key mistakes that I've seen traders make over the last few days within these markets is saying that when the market does fall and then the futures prices are pointing to a stronger open to the market, is it's people lumping on to buy the markets on the back of that. Now, just because markets start in a positive manner, and we all know this to be the case, but just because they start positively doesn't mean they end positively. And that is something which shows us how sensitive these markets are to the headlines which are coming out around coronavirus. Because we have seen, again, and this happened just yesterday, but we have seen markets try and recover from big falls, 1,000-point. We saw almost 2,000-point move on Monday. The next day, we see futures start in positive territory. However, throughout the session, wipe away those gains. Yes, we start positively, but we wipe them away. Now, if you look at this chart here, this is stereotypical of how this market moves. And I'm just going to put a line in here to show you something. So I just want to highlight this lower point here, where that red line is. And let me just, we'll actually make that a little bit bigger. Just to, oh, not like that, right? Let's highlight it, make it a little bit bigger, so we can get a little bit more of an idea of where we're talking about this. Okay. That's our level. So if you look at that level here, this is a stereotypical, something called a dead cat bounce. Happens continuously on the markets during times of turmoil, if you like, because really that's what we've got. We do have financial market turmoil at the moment. Now, as that market falls, and you can see this fall, see the fall from the highs here, you can see how much we've gone down. It's very easy to look at this sort of chart, look at how the markets have moved, and kind of just play it off as, yeah, it looks like a big fall. Something which will really highlight that to you is if you look at the opening prices up here. And again, let's stick this a line at the top here, a resistance line at the top here. and look at that level, 29,602. Let's look at where that last line at the lower point is. And this is over the case of a month, 3rd of Feb to just over a month, 3rd of Feb to the 6th of March. You can see that the move there has gone from 29,602 to 24,685. Astronomical moves to the downside. But this is the area that I want to talk about here. This movement here, this just jumped to the upside. What that is such a stereotypical part of how these markets will move, because you get the aggressive move to the downside, and we know how strong that's been, but that little tick to the upside there is what's called a dead cat bounce. Now, those of you who need to be explained what a dead cat bounce is, I'll give it to you in very layman's terms. You drop a cat from the top of a building, it hits the floor, it bounces, only bounces once and doesn't bounce very high. You drop your cat from here, market falls aggressively, that's your little bump higher. You can see that there. Now, a dead cat bounce is stereotypical for these sort of markets because we know that the markets will try and recover. Bulls, so meaning people that are trying to buy this market, they look to try and jump in at areas where the market has overextended itself. And of course, you have to look at how people are looking at these markets, how people are looking at this coronavirus story. If you talk to anyone about it, they will tell you that it's all a fuss about nothing. Okay, they'll tell you it's all a fuss about nothing. Now, bear with me 1 second. I'm just going to interject here quickly because there is if you want to ask a question, then please feel free to. Please feel free to ask a question if you want to. I can see the questions that come in, so I'll try and answer as many as I can. Okay, so I'll answer them. I'll try and answer. Some I'll answer to everyone. Some I will try and stick away. Okay, so and as I said, everyone surrounding this coronavirus story is talking about this being it being an overreaction. So everyone's overreacting, the market's overreacting, it's not as bad. Now, of course, there are some people that say that it is, but they'll talk about this as being an overreaction. So whenever we see an overreaction, which would be this huge downside fall, there are people, traders, looking for opportunities and will just try and buy into the market at those lower points. Of course, the old stereotypical adage to the markets is you buy at the low points, buy at the low, sell at the high. That's how we make money. So when the markets are at these low points, people are looking for opportunities. Traders are looking for opportunities. They will buy into this market, which is why we always get that upside move, that dead cat bounce, because opportunistic traders are buying in, looking to take some upside. Remember, these markets are human. The financial markets are human, living, breathing things. Okay, they're dominated by human beings. Okay, a lot more these days, they're dominated by algorithms. Algorithms are written by people. The markets are living, breathing things. People buy, people sell. That's how this market moves. And when the buyers come in, the market jumps. However, what we look at here is that the overreaction of the market wasn't going to be short-lived. It wasn't going to be a short-lived thing. The market was going to overextend. It was going to be aggressively lower. So what would have been a key signal to this would have been things called, 2 points in here that I want to show you. Number one would be a bearish engulfing candle. Bearish engulfing candles. Now this one here is not quite a fully bearish engulfing candle, but what a bearish engulfing candle does talk about is it says it's a candle, again, and these are, each individual bar here is a candle. This is a candlestick chart. It's a candle that completely encompasses the full day's move, the full previous day's move. And that's exactly what we got here. So that negativity, that after the market has rebounded, that negativity that instantly comes in is a key indication that the market is looking to overextend this downside, is looking at the bearish side of these markets. it's looking at the downside more than the opportunity, more than the positivity. So the bulls have come in, they've bought the market at this lower level. The dead cat pouncers come in. You've dropped the cat from the height, it's fallen, it's bounced, and now it's hit the floor again. And not only has it hit the floor, it's smashed back through the floor and started going lower. So this is how markets, the markets are behaving. And we can't rule out the fact that there will be other opportunities where the market will jump to the upside again. Just look at what's been happening over the last few days in these markets. You can see this for yourself. Now, something that I will highlight in how the markets are performing here is, again, something that gives us an indication that maybe there could be gives an indication of where we could be going on our next move, in what direction we could be going on our next move. And it's this candle in the middle here. It's this doji candle. Now, a doji candle, again, this middle one here. And for those of you who don't know don't know how the candles, what the candles are telling you, I'll briefly give you that information. So the main body of the candle here, so probably best looking this one here. The main body of that candle is colored white in this situation, which means that's down. Now, obviously, color schemes change, so you can change that to whatever you like. But the color scheme here, the white means it's a down candle, which means the flat opening line at the top is the open. The flat line here at the bottom is the close, because it's fallen down. And the shadow, as it's called in the market, or the wick to a candle, as some people like to call it, is on the extremities is the high and the low. So that's what that's giving you: the high, low, open, and close. Now, on that downside candle, that's what we got. Now that candle clearly shows you that there's a negative move. This candle here clearly shows you that there's a positive move. Clearly shows you that the market is moving to the upside. Now, what this candle here shows is indecision. A doji candle is a reversal pattern. It's a reversal signal within the market to say that after a lot of downside, after an aggressive fall, or this can happen on the upside as well, but after a big move, the market is now undecided. And this is what we're getting here. Now, this is where we could get caught. As traders looking for opportunities in volatile markets, this is where we can get caught. So we must be cautious. We must be cautious around these situations, because old style bits of technical analysis and the key technical analysis, the bedrocks of technical analysis can sometimes go out the window because markets are too volatile to follow what they're looking at. So a doji candle would be a reversal pattern, okay? Which meaning in this situation, the markets have fallen lower. We have a reversal pattern here. If we follow the textbook, this is going to bounce higher, okay? Now, we don't know. This hasn't happened yet. This is just the last couple of days. But what this is showing, what this would give us an indication to show, is that this is going to turn higher. However, in this situation, we have to, and again, those of you that came to our seminar when I was talking about technical analysis previously, I would have told you that the best trade, it puts fundamental stories and technical stories together. Now, the reason these markets are moving is a fundamental story. It's fundamental analysis which is driving this market, because the coronavirus story is a fundamental story. Now, if we look at this market, what the fundamentals are telling us is that we have to ask, why is this market undecided at this point? Why is the market changing? Is it because coronavirus is getting better? Well, no, that's not the case. And we know that to be the case because we watch the news, we read our websites, we look at what's going on, we're looking at our analysis. We know it's not getting better. What we do know is that there is a concerted effort by governments and central banks to do something about it. And that is why this is undecided. So over the last couple of days, what have we seen? Over the last 7 days, we've seen the Fed cut interest rates by 50 basis points. We've seen the Reserve Bank of Australia cut interest rates by 50 basis points. We've seen the Bank of Canada cut interest rates. And today, We've seen the Bank of England cut interest rates. Something is happening in the market, giving us an indication that there is indecision here. And is this indecision from traders? Well, if you take that into consideration, probably not. What this is markets reacting to what the central banks are doing, because the central banks are trying to calm us all down. They're trying to calm the markets down. They don't like panic selling. And there is a very old adage, and you will have heard many people in the market say this numerous times. The market hates uncertainty. In this situation, in the coronavirus situation, uncertainty is exactly what we've got. It dominates everything. And what the central banks are trying to do is calm that down. Now, what they actually end up doing is make the uncertainty worse, because what people do, and again, this market is a human, living, breathing thing. What people do in this situation is they panic. Well, and they think to themselves, okay, the Fed have cut interest rates by 50 basis points at an emergency rate cut. The last time this happened was in 2008, the 2008 financial crisis. Just before Lehman Brothers went out of business, there was an emergency rate cut. The rates were slashed, and the markets couldn't, and the market didn't know what to do, didn't know how to behave. And that was the situation that it left us in. Now, what did that do in 2008? Did it calm the markets down? Absolutely not. Absolutely no way did it calm the markets down. What it did is it exacerbated the situation. It made individuals, it made traders think that the problem was bigger. The problem was as big as it turned out to be, of course, in 2008, but that's what it confirmed. And that's exactly what it's confirming this time. It's confirming that the authorities, so the banks, the governments, they are equally as worried as anyone else about this. So that's why markets are undecided. So do we, in this situation, go, I'm going to buy? I'm going to buy and ride this higher. Do we do that? That's not the answer this time. The answer this time is we have to be patient. We have to be patient in these markets and look to see exactly where we go in this situation, because no one can argue the fact that we may see further aggressive selling points within this market. Because at the moment, a 1,000 point move on a daily basis is not out of the ordinary. And that is key. That is a key point. Now, that's just talking about the global indices. That's talking about financial markets. Now, I just want to show you something else. Just want to show you something here. Let me just look at what we've got. Someone's asking me here, could you repeat what you've called the three candles below the red line? Well, we've not called them anything, but this middle one is a doji, and they're all dojis. Now, they're different kinds of dojis. This one is a gravestone doji. Okay, where is it? Is it a gravestone doji? Maybe it's not. Some people call them dragonfly dojis. Okay, but this is a gravestone doji, meaning it's at the top of the body of the candle is at the top. It's at the higher point. Okay, it's at this higher level. And what you can also see from this candle down here is the fact that we have this point and this point are exactly the same areas. Okay, meaning that 24,685 level is quite an important one. So that's what that shows us. This is a doji. A doji is somewhere where the small body is in the middle. It's closing up very, very close to where it opened. And you can see it's in the middle of the high and the low. So this day was an enormous day. This is yesterday. This was an enormous day. It was almost 4,000 ticks yesterday. It went 1,000 points up, it went 1,000 points down, and ended up closing 1,000 points higher. Okay, so we can see why there's so much movement here. What I just was going to show you was something slightly different here. Let me just show you this. Now, the reason this is something that we've been looking at to keep an eye on the coronavirus cases. To give you an indication of exactly what's going on. Now, coronavirus cases, 121,487 globally. 121,487 487. Is that a lot? For me, it's not a whole host. It's not a whole host of people. Yes, it's a big number, but we have to take this on a world population scale. 121,487. The problem with it is it's rising. That's the issue. It's not really the amount of people that have this. It's the fact that it's rising so rapidly. Deaths, 4,382. The amount of people recovered, 66,912. While this number is above this number, people will be calm. What's key here, again, 50,000 active cases currently globally. 44,000 are mild, that's 89% of them. 5,750, 11% of them people still serious or critical. 66,000 people have recovered, 4,382 deaths. Now, this breaks it down by country as well. So this will break us down by country. Obviously, China is the key area. Okay, China's the key area. This website is updated on a daily basis. Okay, midnight every day it updates. So China, 80,000 cases, 34 new cases. Now, the most important number here is this one. The new cases in China. New cases in China, 34. Now, that gives us an indication that these things are set down. They are starting to calm down, especially in Wuhan and the provinces which have been an issue before. They show that they're calming down. They're nowhere near as huge as they were previously. Okay, new deaths 22, but new cases 34. Okay, so really, really interesting numbers in there. Let's scroll ourselves down and look at the other places which are going to be key. Now, we have to look at places with, number one, close to where these have been outbreaking. Of course, Europe it's been struggling. So Italy, 10,000 cases, that's the next biggest. You look at the US, this is going to be the area where we have to see how quickly this spreads, how quickly this becomes a much worse situation. Okay, so 1,000 cases there, 22 new cases overnight, 1 new death. So you can see that, okay, this is growing. This is a big issue, but what needs to happen is it needs to be controlled. And that's what's going on at the moment. And it's as we said previously, it's not necessarily the issue, the issue with the risk to life. That's not necessarily the issue, but it's that economic, that financial impact, which is massive, massive problem here. That is a massive problem. So that's what's causing the worry. That's what's causing markets to be particularly under pressure. So that's the problem that we have. Now, let's flick us back to the trading side. Okay, so we're back on our MT4 platform. So what we want to know about this is, where do we trade? What do we look at? Where should we be making our decisions? Well, we could look at stock markets, the major indices like we have open here. We could look at those, and that could be a key area for us to focus on. But it's so unknown. The situation is, the market is so erratic. We can't make a decision one way or the other about where this market is going to go. So what we have to do is look towards other areas of the market. Now, what happens in times when markets are particularly volatile like this? Well, you've heard this saying before. People move to safe havens. Safe havens are the area that they go to. So yes, the Dow Jones is here. Now, we don't know what the Dow is going to do today. Now, I can give you an indication. Obviously, the market has been open, and it's falling that little bit low. Okay, so we know that situation to be the case. Okay, and if we just look at the Dow at the moment, it's down another 800 points. So looking at this, looking at our chart here, in the grand scheme of things, this looks like a particularly small candle. That's an 800 point down day currently. So we continue to see stock markets under pressure. So where do we look to? What else do we look for? What areas do we focus on? Well, we look towards safe havens. We look towards safe havens. Now, what are the safe havens? Now, the reason we call them safe havens is because they're supposedly less risky. So they're less risky places, historically less risky places for your money to be, for your trading to be happening. Now, one of those is gold. Always called the safe haven. Let's open up our chart. There's our gold chart. Let's take the grids off. Can't stand the grids on here. That's an hourly chart. Let's look at a daily chart. And let's look at the situation with gold. Let's have a candles. There we go. So that's our daily chart. Now you can see that big falls are happening on gold. This candle in particular, huge downside move. We have recovered. And the last few days, since the escalation of what's been happening here, we've moved higher. Currently trading 1662. Okay, that's up about 0.8%, up about $12 today. Okay, so a pretty big move. Now let's look from a technical analysis point of view where the opportunities are from here. And I can see already that there's a longer term situation here with the trend line. So let's just take this out. We can see trend lines coming in from these points. Now, where do we stick them? Well, let's look at our initial places where we can look to trade. Now, I'm just going to put a couple in just to show you what's going on. And I want another one here. So I've got a 2 in there. But what's causing us an issue is this low that comes down here. Now, again, anyone that was at my seminar that we spoke to, and of course we'll be doing more seminars for you guys in the next couple of months when I'm back in Kenya, back in Nairobi. But what we get here is this, a textbook would usually tell us to ignore this move. Okay, it would usually tell us to ignore this move and ignore then the trend line and not try and trade this. However, we have key situations here. So we have our 2 upside points here. There's another question here. Euro dollars have exhibited breakouts. How can we determine if the breakout is fake or genuine? I will let you know. We will look at euro dollar in a couple of minutes. If you want to look at a particular instrument, euro dollar or something else, then please let me know. And I will do that. So please put in the Q&A if you want to ask anything. Yes, I will make those a little bit stronger for you. Someone said, can I make the lines a bit stronger? Yeah, no problem. Hopefully that's better. Let's add the next one. Okay, there you go. Right, let's look at, so we'll look at euro dollar in a moment, but let's continue with gold. So this would have been a fake breakout, as someone just mentioned about euro dollar. We know gold is looking to the upside, okay? We know this, we know the situation here. So we have that upside. We have this downside here. So we've got 2 areas here. We've got this area where the market has bounced, it's gone higher. And then looking towards this upside here, these 2 points, 1, 2, those 2 points here. So the market is in a situation where we have support, sloping support here. Yes, a fake out here, but still we have a support here. We have support lower. So we have areas where over the last few days, the markets have been trading. Okay. And remember, now this is a daily chart. So this takes us all the way back to November. But when we focus in, it gives an idea about exactly where these markets have been, where these markets are now. We have this issue. We have a situation when on the upside, the market's here. So we range bind ourselves. Now, what we say again about our markets is that gold is a safe haven in times when markets are looking for less risky assets. Coronavirus being a key indication of that, is that this is going to show some upside. So gold is going to show some upside. This is why a lot of people will be looking to trade gold and will be saying that this has upside. Again, three trend lines on the upside show us that that's the situation. If I take that out, we then have more. So we then have more from these lows. So let's get our level in from this low. I've actually placed that slightly wrong, but still, there we can see, take that out a little bit further. You can see that our situation gives us 1, 2, again, from a textbook, as I told you previously, 3 touches is what we want, but then we wait for this market to come down lower. Yes, this hasn't broken out here. Yes, this is on the upside, is starting to show signs of holding up, but still, if the downside comes in, we have 1, 2, 3 areas of key downside support where the market would likely bounce. And if you look from this point, from our low point to our high point, gold is strong. We know gold is strong. Does it mean there won't be downside in between that? Of course it doesn't. At one point, markets will give up. Remember, at one point, one of the key reasons that gold will sell off, I can tell you this now, one of the key reasons gold will sell off is at one point, there will be headlines that come out and say coronavirus to a certain degree is under control. Risk on. We have a risk on, risk off scenario. Currently, we're risk off. Risk off means safe havens come and take the markets. This situation shows you if at one point people will say coronavirus is under control in certain areas. Risk on. People look to risk your assets, gold sells off. How far? Well, we've got 3 levels that will give us an indication. If all 3 are broken, which they won't be, we get downside. We'll get further downside. But from a gold point of view, that's where we are. Now, we need to look in shorter term, not 30 minutes, hourly. So let's look hourly. Let's look at our situation from an hourly point of view here. Now, these lines are our trend lines from previously, remember? Okay, so they are still on our chart. Let's look where we are from this point of view. Okay, I have a trend line from this lower point. I take in here. And again, remember, this is basic forms of TA. Okay, we're just looking at levels. We're just looking at levels. Nothing important. Nothing necessarily overly complicated. We're looking at levels. We can see this here. We also have a situation here where we have left shoulder, head, potentially right shoulder. So head and shoulders formation. Now, head and shoulders formation, again, I can add this in most probably. Let's, no, I won't add that. I can add it here. Okay. I would add that here if I knew how to do it, but I don't. Left shoulder here, head here. This is forming our right shoulder. Our right shoulder, if that starts to turn, it brings us down to this level. This is our neckline. Now, our neckline on a head and shoulders formation is our breakout point. So the situation we would have here is left shoulder, head, right shoulder, if this turns. If it breaks below our neckline, that gives us an extended downside scenario. However, we don't look at that situation in this case because what is coronavirus? Again, as I said before, it's a fundamental story. So we must put the fundamental story with our technical analysis, because what someone asked me earlier, what is the situation which causes the most amount of fake outs? It is solely using technical analysis during a fundamental story. And this is a fundamental story. So that's our gold position at the moment. That's our gold situation. Okay. Now, another safe haven. And again, guys, remember, please ask me if you want me to look at an individual euro dollar or CAD or anything in particular. We'll look at the oil price in a minute, but if you want me to look at any of those, then please tell me. I'm going to look at dollar yen because it's the next key safe haven. And for some reason, I've got this in. So let's get these grid lines off because I can't stand them. Let's get our indicator list. Let's lose this. Our CCI. That's gone. Okay. Now let's look at our chart. Now let's see what we've got. Dollar yen falling through the floor for a long period. Because why? The yen. The yen is a safe haven. Okay, it's not dollar yen that's the safe haven, remember? Yen is the safe haven. Okay, so yen is a safe haven. That's where we look for the yen pairs potentially. Someone asked me for euro yen. Yeah, this very much will tie in, similar situation. So yen is the key one here. Look at the gap. Look at the gap in the markets. That's what we've got. We've started to recover. Why have we started to recover? Why have we started to recover here? Because central banks have been pushing. Central banks have been adding stimulus. Central banks are trying to make sure that the economy doesn't fall apart. They're trying to normalize this, trying to normalize the markets and take away the sting. Won't happen. We can't do that. So this is the downside we have. This is the 4-hourly chart. Look at that movement. You talk about steep moves. Now, what's interesting here is we talk about steep moves in the market. The worrying thing about a steep move, markets aren't supposed to move like this. Daily charts aren't supposed to show downside moves like this. The reason they do is because we have these massive stories. Now, when we see such a move here, this shows us that we will get some kind of recovery, which is why, if you look here, and again, I can show you this, zoom, zoom, zoom. What can we see here? Upside, upside. Not closed yet, but upside potentially. You can see this here. The move was too fast. The move to the downside was far too aggressive. So now what we need to do, what the market needs to do is correct itself. Does the correction take us all the way back to the top? No, because that's not the relevant, that's not the real market value. What it does is it corrects itself, because this is a knee-jerk reaction. So down to here is a knee-jerk reaction. Then the market must try and normalize itself. And that's exactly what it's doing. So where does it go? What does dollar yen do? Well, dollar yen's a safe haven, isn't it? We know that the yen is the safe haven. Okay, so do we see this go lower? What did we say earlier? Dead cat bounce, downside. This is the upside. Does this recover all the way up here? Or does this dead cat bounce? Remember, dead cat bounce is a thing. Sounds ridiculous, definitely is a thing. Someone asked me for euro dollar. Let's look at euro dollar. Oh, there we go. Let's look at euro dollar. So let's get rid of these grid lines again. Can't stand them. Okay. Key areas here. You can see our key areas. Let's look at our trend lines. Let's put our trend lines in. There's our downside. Very good trend line here. Look at this. This is to the tick. Euro dollar is looking to the tick. 1, 2, 3 touches. Downside for euro dollar on an hourly chart. Also, something else I mentioned when we were in when I was back in Nairobi last time. What does the market do? Whenever there's a gap, it tries to fill the gap. Yeah, it tries to fill the gap. Filled. Gap filled. Look where what the market did directly after that. So what does this give us? This gives us a key area. If I could move this. There we go. Gives a key area of support on the downside. Now we have a range-bound market. Now we have a range-bound market with a narrowing formation because we have a trend line in place. Our trend line's in play. 1, 2, 3 key touches, but our 112.74 level on the downside is looking important to us as well. The market's narrowing in. So what that means is something must give. Something must give between this low and this high. If it breaks out to the upside, where does it go? Well, we look towards the highs on the upside. The gap coincides with these upside levels. That's what we've got in play. So if we break out of here, we look to 113, 114 on the upside. Yes, we're looking at big moves, but this is because this is what this story is giving us. Now, why are the moves happening in euro dollar? Why is that being impacted by coronavirus? Well, it's not necessarily, because it's being impacted by the Fed and the ECB. Now, that we have, why this is important and why euro dollar is important is because tomorrow we have the ECB rate decision. Now, what has been one of the key noticeable things that has happened over the last few days, last few weeks? The Fed has cut rates, the RBA has cut rates, the Bank of Canada has cut rates, and the Bank of England has cut rates. The only major central bank that hasn't, that is affected massively by this, of course, is the European Central Bank. Why can't they do that? Because they haven't recovered from the 2008 crisis and the 2011 crisis, because they haven't been able to move their rates higher. And people say, why is there such an obsession for central banks to get back to a normalized interest rates? Now, the reason there is such an obsession to get back to normalized interest rates is because you have to consider interest rates like a loaded gun. When interest rates are at normalized levels, they are a loaded gun and they are protection. Consider coronavirus something which is coming to attack this economy. It's a beast that's coming to attack the global economy. Well, the Bank of England have noticed that coronavirus is coming to attack its economy. It has moved interest rates higher from the 2008 crisis. It has bullets in its gun to attack the beast which is attacking its economy. It fires its bullets, cuts interest rates, gives the economy some breathing room. Same for the Fed. The ECB have not raised interest rates. They can't. The economy is under too much pressure. It's pretty much still in recession. It hasn't got any bullets in its gun. It can't fire them. So the Eurozone is being attacked. It just happens to be, outside of China, the most affected area by coronavirus. A perfect storm of downside for the Eurozone. Does that mean the euro falls? Potentially. It means European stocks are massively under pressure. Does it mean the European Central Bank don't have any bullets to fire at all? No, because just because they don't have interest rate cuts they can do, doesn't mean they don't have other things they can do, which of course they previously have done. They still haven't pumped up their balance, they still haven't started removing any stimulus from the balance sheet, which causes an issue. However, that's something completely separate. We're running out of time, but this is the euro-dollar situation that we have here at the moment. One thing I want to look at here is oil prices. This is key. Probably the most key area financially and globally that the coronavirus will affect. Let's look at this. Again, let's take these ridiculous grid marks off. You can see the gap already. I can show you, you can see it. This is hourly chart. My candle here. Look at that gap. Look at the gap we have here. Massive, massive gap. Let's look, find the levels. $41.80. Gap low, all the way down here. $30.26. The low down here is, I think, $27.20 or something insane like that. $29.46. This is an indicative chart. I'm pretty sure it's 27 something. Anyway, look at the downside moves here. Now, why has this happened? Well, because oil is under pressure. Again, supply and demand market. Okay, supply and demand market. What happens when people aren't going out, aren't traveling, are being told to quarantine themselves? Oil's not getting used. Means there's more oil. There's more oil around. What happens when there's too much oil? Prices, they fall aggressively. Okay. Now, there was a big discussion the last couple of days, Monday and over the weekend, because what we were looking at from a market point of view and from an oil point of view is whenever there's a situation where there's too much oil, we look for OPEC to cut output. Okay. Now, OPEC is dominated by Saudi Arabia. What if Saudi Arabia just asked Saudi Aramco, which is basically the Saudi government, what if they just asked Saudi Aramco to do? Push their output to maximum levels, $13 million a barrel a day. 13 million barrels a day. So they pushed that higher. They've pushed that higher, and that is making these prices fall lower again. What have we got here? Massive sell-off, dead cat bounce. Market's moving lower. Market's moving lower at the moment. Now, why is there a situation? Why does Saudi Arabia want these oil prices to be low? Now, again, this is very conspiracy theorist, if you like, but the reason they want them lower is because it can drive other oil producing nations to pretty much out of business. Now, this all goes down to break-even prices. Now, break-even prices when it comes to oil are how much it costs a country to extract oil from the ground. Now, there is a cost per barrel. Some countries have a massive extraction cost at potentially anywhere between $60 a barrel and $120 a barrel. I think it was once estimated that Venezuela's, now obviously Venezuela is a country economically which has been under pressure severely for years, but it was estimated that their break-even price for extracting oil from the ground was around $120 a barrel. What is the extraction cost per barrel for Saudi Arabia? $8 per barrel. $8 per barrel. It cost them $8 per barrel to get it out of the ground. They're selling it currently at what? $33.96, $34 a barrel. They have the pockets to continue to drive this lower. Now, why do they want to do this? Well, because you have Donald Trump, and again, those of you who were at our seminar talking about Donald Trump, we discussed the oil price. He wants to make America great again, put America first. Okay, and of course we're getting away from coronavirus here, but this is how this all interlinks to an economic story. Because this situation, because Donald Trump wants to make America great again, he's trying to make America self-sufficient within oil. He doesn't want America importing oil from anywhere. He wants to produce it all within the United States. When a situation happens like this, Saudi Arabia go, fantastic, no problem whatsoever. We will drive that price so low that the US can't continue to do it in a cost-effective way. So what will they have to do? They'll have to start importing oil from other areas, which means, doesn't necessarily mean Saudi Arabia, because the US aren't big importers of Saudi Arabian oil. Okay, they get it from other areas. However, it means those other areas, other regions open up to Saudi Arabia yet again. They can afford to make this low. This puts Russia under pressure. The non-OPEC nations are put under pressure by this, and there will continuously be pressure to cut output. It is a miracle at the moment that output hasn't been cut by OPEC, because at the moment, this is the biggest risk to global oil demand that we have had for years and years, decades most probably. So this story is a massive story. It's not just about the health of millions of people, thousands of people, but which could grow to millions, but it's not just about the health of people, whether they get a cold or a cough or a fever or whatever it may be. Or it's not about looking at the symptoms, about who's going to get it, who's not going to get it. It's about the financial implications of what this could do economically to the world. And the fact that we've seen the first emergency rate cuts from major central banks since the 2008 financial crisis, which pretty much crippled the world, means that this is a massive deal for the financial world. Now, does that mean for us as traders that it's something we leave alone? Absolutely not. It means that from an oil point of view, there are opportunities. It means from a gold point of view, there are opportunities. Dollar yen, there are opportunities. Stock markets, there are opportunities. There are so many areas that we can look at and help ourselves trade. Okay, there are so many areas that we can, if we do our analysis correctly, we can make correct decisions. We can make money from trading. But we can't underestimate the massive impact this will have economically and, of course, on the markets. Guys, thank you very much for listening to me today. It was great to have you with us. And again, tomorrow we have a webinar about how to protect yourself when it comes to these massive risk events. But for now, thank you very much for listening, and I will speak to you again. Thank you.